money. We all use it, hold it, earn it. But have you ever stopped to wonder where it really comes from? Or, how its value is actually decided? It's more than just dollars. Look closely. It says Federal Reserve note. And behind that, well, there's this complex, often invisible system that in many ways makes money appear almost out of thin air, the U.S. Federal Reserve. Today, we're taking a deep dive into this truly unique institution. It's part private bank, part government agency, and its decisions ripple across our entire economy, often with surprising and, sometimes unintended consequences. We've pulled together articles, research, detailed notes to be our guide through its fascinating history and the key players who shaped it.
And a focus today is really on how the Fed, particularly through its powerful policymaking arm, the Federal Open Market Committee, or FOMC, directly influences the quantity and value of American money. We'll meet crucial figures who've steered its course, including one remarkable dissenting voice whose warnings proved surprisingly, almost chillingly prescient.
Right. So our mission for this deep dive, to really unpack how this powerful institution has not only responded to, but at times maybe even contributed to, America's biggest financial crises. And most importantly, what that means for your understanding of the economic landscape today. So how about we start by tracing the Fed's origins and those foundational tensions that shaped it right from day one?
Absolutely. It's quite remarkable when you think about it. The U.S. Constitution doesn't actually, require a central bank. Yet, for about a century, the nation tried and, frankly, struggled to function without one. There was always this fundamental tension, this push and pull.
With what exactly?
But between the clear, often desperate need for some kind of central financial authority versus a really deeply ingrained American fear of concentrating too much power in too few hands. So when the Fed was finally created in 1913, this tension was basically encoded into its very DNA. It tried to decentralize power with regional banks, like the one in Kansas City. But ultimately, control became much more centralized in Washington with the Board of Governors. It was an uneasy compromise from the start.
And that inherent tension, that sort of tug of war, became incredibly stark in the 1970s, right? Because on one side, you had economists working inside the Fed, like Thomas Hoenig, who started in '73 in the Kansas City Fed's Bank Supervision Department. His team's job, was basically trying to keep banks safe.
Right, poring over their books, checking for risky loans, the nuts and bolts of regulation.
Exactly, keeping the system safe. But even as Hoenig was doing that, the powerful FOMC in Washington was making these big policy decisions that fundamentally changed how banks behave sometimes, undermining those very efforts. What exactly was the FOMC doing?
That's a great question because it really gets to the heart of the problem back then. The FOMC kept interest rates extraordinarily low all through the 1970s.
Why low? What was the goal?
Well, the intention was to boost economic growth, boost jobs, especially after a couple of recessions. Seems reasonable, right?
Yeah, on the surface.
But this policy had severe ill effects, as our sources put it. Most obviously, it fueled rampant consumer price inflation. I mean, by 1979, prices were surging 10.7% a year. Think about what that does to your grocery bill, your gas.
Everything, yeah.
But crucially, and this often gets missed, the Fed was also inflating asset prices. Things like farmland, commercial real estate, oil wells.
Okay, so not just the price of bread, but the price of the farm itself.
Precisely. And these rising asset values, which banks often use as collateral for loans, encouraged much riskier lending. Banks were pushing further on the yield curve, as they say, meaning they were chasing higher returns by making riskier loans. Imagine it like reaching for a higher hanging, juicier apple, but the branch you're standing on is getting weaker and weaker. The fall would be much harder.
So with all these ill effects, building up price inflation, asset inflation, risky lending, what finally turned the tide, who stepped in and how did they even start to tackle such a deep problem?
That's when Paul Volcker took the helm as chairman in 1979. And Volcker was serious. He really understood he was fighting two cousins, as he called them. Not just consumer price inflation, but asset inflation, too. And critically, he recognized the Fed's own role in creating both problems.
So he didn't just blame external factors.
No, he saw the internal policy connection. And he initiated what he famously called brutal shock therapy. He started raising short-term interest rates dramatically, from 10% in 1979 up to an unprecedented 20% by 1981.
20%? Wow, that sounds devastating. What were the immediate effects?
Oh, it was devastating, absolutely. The economy plunged into a deep recession, millions were laid off, and those inflated asset prices, they collapsed.
Like the farmland and oil you mentioned.
Exactly. Farmland prices dropped 27%. Oil plummeted from over $120 a barrel down to just $25 by 1986. This created a huge cascade effect, leading to waves of bank failures. Honig, remember him, working in the Kansas City Fed District, he described it grimly as the unpleasant job of figuring out which banks could survive and which were basically doomed. It was a really brutal reckoning.
So it sounds like the Fed under Volcker eventually got the credit for ending that great inflation and, saving the solvent banks that made it through. But you mentioned earlier research decades later showed the Fed was also kind of responsible for the whole disaster in the first place. How does that work?
That's the critical insight from later analysis, yeah. The research showed that before Volcker, the FOMC had consistently prioritized keeping employment high over controlling inflation.
So jobs over prices.
Pretty much. Whenever unemployment started to tick up, they'd back off from raising interest rates. This essentially allowed both kinds of inflation price and asset to just keep building and building for years. So, in effect, the seeds of the crisis Volcker had to clean up were sown by the Fed's own earlier policy choices.
And this era also gave birth to that phrase we still hear constantly, too big to fail. What exactly happened there? What solidified that idea?
Well, it started with the failure of a relatively small regional bank called Penn Square in Oklahoma, I think. Its collapse exposed these deep, intricate connections across the whole banking system,
Okay.
particularly with Continental Illinois, which was a very large bank based in Chicago. When Continental looked like it was going under, the fear was that it could take down maybe 2,300 other banks with it.
Wow. A domino effect.
Exactly. So to stop a complete systemic meltdown, the Fed stepped in and essentially rescued Continental Illinois. And that set this powerful precedent. If a financial institution gets big enough and its failure could wreck the whole system, it's too big to fail. The Fed would likely step in.
Which basically guarantees a bailout, doesn't it?
It certainly creates that expectation.
Okay, let's fast forward a bit. October 1991, and Thomas Honig, who we've been tracking, takes his first seat on the FOMC as a voting member. So he moves from being a regulator on the ground to a policymaker in Washington. Now, the 1990s, people often remember that as this huge boom time, right? The internet's exploding, stock markets are soaring.
A dot-com boom, yeah.
But our sources point to this corrosive layer of weakness underneath it all, including something called a jobless recovery. What was really going on then, and how did the Fed, now under Alan Greenspan, handle this period?
It's a really interesting contradiction, isn't it? Because while tech was booming, that jobless recovery meant that even as the overall economy started growing again after an earlier recession, new jobs weren't being created at the same rate. It felt uneven.
Oh.
And Alan Greenspan, who was the chairman then, he kicked off what became known as a new era of easy money. His basic policy framework was control consumer price inflation because that's politically popular, nobody likes rising grocery prices.
Right.
But largely ignore asset inflation. People didn't call rising stock prices or housing prices inflation. They called it a boom. They liked it.
So rising stock prices were okay, rising bread prices were not.
That was kind of the operating principle. And we saw this most dramatically in the stock market, especially tech stocks. The NASDAQ index jumped over 80% in 1999 alone. Just wild speculation.
So Greenspan must have been aware of this potential bubble forming. But his strategy wasn't to, try and stop it.
Exactly right. He was aware. He even admitted the stock market had, and I quote, eased regrettably more than I would have liked. A bit of an understatement.
Yeah, just a bit.
But his approach wasn't to try and prick the bubble gently. His strategy was explicit. Clean up after the bubble, meaning let it run its course, and then when it inevitably bursts, cut interest rates aggressively to cushion the fall.
And we saw that happen, didn't we, after the dot-com crash?
We did. The dot-com crash in 2000 wiped out a staggering $1.76 trillion in value, and the Fed responded by slashing rates.
It really sounds like a pattern starting to lock in here. Stimulate the economy, turn a blind eye to asset bubbles, then ride to the rescue when everything collapses. Is that a fair summary?
That's exactly what our sources suggest. This approach really solidified a permanent pattern for the Fed, or at least one that lasted for decades. Stimulate the economy without stoking consumer price inflation, keep that lid on, largely ignore asset inflation, let the good times roll, and then step in decisively to bail out the system when asset prices collapse.
Giving the Fed this image of
the financial rescue artist, as one source called Greenspan. And this created a widespread belief, almost an article of faith on Wall Street, that only the Fed had the power to stop larger disasters. This made future bailouts seem not just possible, but almost unavoidable.
And that pattern, that expectation, really set the stage for the biggest asset bubble yet, didn't it? The one leading up to the 2008 crash.
Directly. The housing bubble and all the complex finance built around it grew in that environment of easy money and the implicit Fed backstop.
Which brings us to 2010. We're post-crash, the economy's still struggling, unemployment stuck over 9%, Europe's facing its own debt crisis. It's a grim picture. Ben Bernanke is Fed chairman now, and he's pushing for these really unprecedented interventions, things like quantitative easing, QE, and ZRRP, the zero interest rate policy.
Right. ZIRP meaning keeping interest rates near zero, basically making it pointless to keep money in safe savings accounts.
And encouraging people, or forcing them really, to look for returns elsewhere, often in riskier places.
Exactly.
And this is where Thomas Honig, the guy who started as a regulator worried about bank safety, becomes this staunch dissenter. He votes no at every single FOMC meeting that entire year. What was driving him? What did he see in QE and ZRP that worried him so much?
It's a fascinating part of the story because his dissents weren't primarily about the traditional fear, consumer price inflation running wild, although that's how it's often portrayed in public.
So it wasn't about grocery prices again.
Not mainly, no. He warned specifically about the locative effect of keeping rates near zero. He argued the Fed's policies were actively, deliberately shifting money away from safe, maybe productive investments into increasingly risky ones. He even pointed back to the 2008 crash, saying the Fed bore, and I quote, a great deal of responsibility for it because of years of low interest rates, high and increasing leverage, and overly lax financial supervision. He saw them repeating a pattern, but maybe worse.
He saw them creating distortions that could cause future meltdowns unrelated to just CPI inflation.
Precisely. Distorted incentives leading to dangerous risk-taking.
Okay, let's unpack QE, quantitative easing, a bit more. Our sources describe it as the Fed injecting trillions of newly created Federal Reserve notes, literally new money into the banking system by buying long-term Treasury bonds. Why was buying long-term bonds such a big deal?
Well, traditionally, the Fed mostly dealt with short-term debt to influence overnight rates. By buying long-term government bonds, they were pushing down longer-term interest rates directly. And crucially, it essentially closed the one safe deposit box, as one analyst put it, where big investors like pension funds or insurance companies could normally park money safely for a decent return.
Forcing them out of safety.
Forcing them into riskier assets, corporate bonds, stocks, emerging market debt, you name it, in what became widely known as the search for yield or the reach for yield. It wasn't an accident. It was an explicit policy goal to encourage risk-taking, hoping it would stimulate the economy.
And Honig, according to your sources, was warning right then about the long-term consequences of this search for yield. What did he predict would happen?
He warned, quite presciently it turns out, that once you start these massive programs, they create so many distortions and side effects that it would almost certainly not be able to end the program without causing massive instability or even a crash.
Hard to get off the drug once you start.
That was essentially his argument. His fight against QE and zero interest rates was, well, ultimately lost. The Fed continued and even expanded these policies way beyond what was initially discussed.
So what were some of those real-world consequences, those distortions created by this global search for yield? Where did the money flow?
Oh, it went everywhere, often into questionable places. For example, huge amounts flowed into the fracking industry in the U.S., despite often inflated estimates of how much oil and gas they could actually produce and the inherent risks. The money poured in because investors were desperate for returns.
They weren't necessarily being stupid, just incentivized differently.
Exactly. The incentives were skewed by Fed policy. Same in commercial real estate. Analysts found bundles of commercial property loans, called CMBS, that had rotten underlying loans, but investors were almost incentivized not to look too closely because they just needed some kind of yield, any yield.
Wow.
Billions also flooded into riskier developing nations, places like Mexico, Poland, Turkey, because they offered higher interest rates than you could get in the US or Europe.
And then you mentioned the strangest one, negative interest rates.
Yeah, perhaps the weirdest creature spawned by ZRRP was the negative interest rate bond. This meant investors were literally paying governments or companies to lend them money.
Paying someone to take your money, that just sounds completely upside down.
It is. It punishes saving. But by 2016, there was a shocking $7 trillion worth of bonds globally carrying negative rates. It showed just how distorted things had become.
And domestically, what about companies? Were they using this cheap money to innovate, build factories?
Well, some did, but a lot of it fueled what's called financial engineering. Instead of investing in R&D or new products, companies took on loads of cheap debt to do things like buy back their own stock.
Which boosts the share price, helps executives.
Exactly. It boosts the share price in the short term, often benefiting executives whose pay is tied to stock performance. But it dramatically increased overall corporate indebtedness. This created a rise in so-called zombie companies, firms, whose profits weren't even enough to cover the interest payments on their loans. They were only kept alive because they could keep rolling over that super cheap debt.
Tying up resources.
Exactly, tying up capital and labor that could have gone to healthier, more innovative businesses. There's an example in the sources Rexnord, an industrial equipment maker. They used cheap debt for acquisitions and massive stock buybacks, which benefited executives and shareholders, but didn't necessarily lead to better products or more U.S. jobs. In fact, they were involved in moving jobs overseas around that time.
So it sounds like Honig's early warnings about how hard it would be to stop these programs were starting to look pretty accurate. Even Jay Powell, who became a Fed governor in 2012, initially argued for the Fed to normalize its balance sheet, right? He seemed worried too.
He did. Initially, Powell warned about asset bubbles and the risk of a sharp correction amplified by a liquidity mismatch. He sounded a bit like Honig for a while.
But then came the taper tantrum in 2013. Bernanke just hinted at slowing down QE. What happened?
Chaos, basically. Markets panicked. Treasury bond rates spiked dramatically just on the suggestion that the Fed might buy fewer bonds.
Just the suggestion.
Just the suggestion. It showed how utterly dependent, how hooked the markets had become on that continuous flow of QE money. And the effect was it forced the Fed to basically backtrack and signal it would be even more committed to continuing on. That original $750 billion QE program, it ended up ballooning to $1.6 trillion.
Wow. It proved Honig right. Getting off it was going to be incredibly difficult without causing mayhem.
It really did. Pulling back looked almost impossible without triggering the very instability they were trying to avoid.
And this underlying fragility, this dependence, seems to have just carried on. By 2019, the official line was the economy was strong, but the financial system underneath sounds like it was still incredibly fragile. What was the first real sign of trouble?
It came quite suddenly, actually, in September 2019. There was a mini panic in a really crucial, normally boring part of the financial plumbing, the overnight cash repo market.
Repo market, what's that, quickly?
It's where banks and other financial institutions lend money to each other overnight, usually using treasury bonds as collateral. It's essential for keeping cash flowing smoothly. Repo rates are normally ultra-stable, barely moving.
And they spike.
They suddenly spiked dramatically. It was a huge red flag.
What did that signal to the Fed? Why was that spike so alarming?
It signaled that the Fed was essentially flying blind in this new era of ZRRP and massive bank reserves from QE. The old tools, the delicate mechanisms they used to use to control short-term rates weren't working predictably anymore. The system was gummed up.
So how did they react to this repo spike?
Almost instantly. They launched what was described as an unprecedented bailout of the repo market, ultimately injecting around $400 billion.
$400 billion for an overnight market glitch. Who was that mainly helping?
Well, the sources suggest it disproportionately benefited large hedge funds that were engaged in these complex basis trades, basically bets on tiny differences in bond prices that relied heavily on those repo rates staying super low and stable. When rates spiked, their trades blew up.
So the Fed bailed out sophisticated hedge fund trades.
That's how it looked. And interestingly, the Fed described this enormous cash injection simply as normal maintenance of market function.
Rem maintenance.
Yeah, which led Thomas Honig to observe later with some clear irritation that the extraordinary had become routine. $400 billion interventions were now just normal.
And then just a few months later, early 2020, the world changes completely. The COVID-19 pandemic hits. How did the financial markets react then?
Oh, it was chaos. Absolute convulsion. The treasury market, U.S. government bonds, supposedly the safest asset in the world, the bedrock of modern finance, it just froze up. People couldn't sell treasuries.
The treasury market froze.
Froze, unheard of. Corporate debt markets ground to a halt, too. Companies, desperate for cash, started frantically drawing down their revolving credit facilities, basically, their emergency bank credit lines. This threatened to just bleed the banks dry of cash. It was a full-blown liquidity crisis, maybe worse than '08 in its speed.
And Jay Powell, now Fed chairman, responded with what was called overwhelming force. What did that intervention look like? How did it compare to everything that came before?
It absolutely dwarfed everything before it. It was the largest, most far-reaching intervention in the Fed's entire history.
Give us the scale.
Okay, first, $1.5 trillion in immediate repo loans to unfreeze that market again. Then a massive, essentially near-permanent QE program. They bought $625 billion in bonds in just 1 week.
1 week. That's
That's more than the entire QE program Honig voted against back in 2010, in a single week.
unbelievable.
And then they went even further. They created these special purpose vehicles, or SPVs, working with the Treasury Department. These allowed the Fed to directly buy assets it had never bought before, corporate bonds, CLOs, those bundles of corporate loans again, even junk debt from companies that had recently been downgraded, so-called fallen angels, like Ford.
So the Fed was directly buying corporate debt, even risky debt. That sounds like a huge expansion of this invisible safety net the Fed put. What did that mean in practice for traders and companies?
That's precisely it. It dramatically expanded the Fed put. It became an almost explicit assurance, not just to banks, but to corporate bond traders, leveraged loan investors, that the Fed would step in and backstop their markets if prices fell too far.
Like a guarantee against losses, almost.
It felt like that to many market participants. It's like giving a high-wire walker a much wider, much stronger net. It encourages bolder, riskier maneuvers because the consequences of falling seem much lower.
And meanwhile, what about help for, actual small businesses, Main Street?
Well, there was the Main Street lending program, which was intended to do that. But according to the sources, it largely failed. It was too complex, too unwieldy, and banks were very reluctant to take on the risk of lending to struggling small businesses, even with the Fed's backing.
So a stark contrast emerges here. You've got millions of people losing jobs, facing eviction, small businesses struggling. But the real bailout, as your sources put it, seems to have been for asset owners. Can you unpack that gated recovery? Who were the winners and losers?
It's a really stark picture painted by the sources, yeah. While ordinary people faced immense hardship, the financial markets and asset owners experienced a remarkably swift recovery, fueled by the Fed's actions. The stock market surged 35% in just 3 months after the initial crash. Corporate debt issuance hit record highs because borrowing costs were so low thanks to the Fed buying bonds.
35% in 3 months, while the real economy was reeling.
Exactly. This was explicitly described as a gated recovery. The money, the recovery, flowed primarily to selected exclusive zip codes, benefiting those who already owned stocks, bonds, and real estate. It largely bypassed working-class communities and those without financial assets.
And you also saw that boom in retail trading, right? Platforms like Robinhood.
Yeah, that was another fascinating aspect. You had this explosion in retail trading, often encouraged by internet personalities. But the underlying mechanics, things like payment for order flow, meant that even this retail frenzy often ended up benefiting large hedge funds like Citadel Securities, who were paying for the right to execute those trades. The small investors were part of the churn, but the big structural gains were still concentrated.
It's almost like the scale of intervention became so normalized, so expected, that it was just accepted. You mentioned former Fed chairs like Bernanke and Janet Yellen called Powell's actions heroic.
They did. And Yellen, who later became Treasury Secretary, even described the Fed as now being the lender of last resort for everyone, including the huge, often opaque, shadow banking system, hedge funds, private equity, money market funds.
Lender of last resort for everyone. That's a massive shift from just being for banks. What are the lasting implications of all this? Where does this leave us today?
That really is the core question, isn't it? Thomas Honig, the dissenter we followed, the guy who warned about this back in 2010, now suggests the Fed is essentially trapped by its own history, its own past actions. He argued that after, quote, 7 years of basically zero interest rates, followed by even more extreme measures, an entire economic system has developed a new equilibrium built around that incredibly low cost of money. Everything is geared to it.
And he's right, isn't he? You can see how the world has reorganized itself, investment decisions, corporate strategies, government borrowing, all based on this assumption of cheap money continuing. Undoing that would be incredibly painful, maybe even impossible without causing massive disruption.
Exactly. Honig reminds us that adjusting back to a higher interest rate environment, which the Fed is now attempting, won't be costless. There will inevitably be winners and losers as the system readjusts, as policies that poured money into risky investments and fueled speculation for years are unwound if they can be fully unwound.
The extraordinary really has become routine, and the distorted has become the ordinary. As Honig wrote back in 2020, these massive interventions, while maybe necessary in the short term during the peak crisis, They place an ever larger mortgage against the nation's future income. Extending them beyond the crisis period, he warned, could have significant negative unintended consequences. Consequences that we might just be starting to grapple with now. Which leaves us and you, the listener, with a really important question, I think. In a world where central banks are increasingly seen as the only game in town, where they become the lender of last resort for practically the entire financial system, how much more debt, how much more speculation can our economy actually absorb before those bills finally come due?
And maybe an even broader question to ponder: what kind of future are we building when economic growth and stability seem to depend more and more on the continuous creation of money by central banks and the tolerance of ever larger asset bubbles? What does normal even mean anymore when the definition keeps shifting to accommodate these unprecedented levels of intervention?